in our financial mathematics, we also have to concern ourselves about what happens if we're borrowing money instead of actually investing money. Now, most of the time, most people are going to be borrowing money from the bank. Either they're going to be loans or lines of credit, mortgages, any kind of things like that. Well, you're borrowing money. And that's going to be a very critical thing to be able to do. You need a good credit score, which means that you need to be able to pay off your debts and you need to be able to borrow money. Not everyone's going to have an infinite amount of money to do everything that they want to do, whether it's student loans, whether it's doing renovations, any kind of thing like that. You're going to need to have some free cash, and banks or loaners are able to provide that kind of money. So there's a few key aspects to loans. First off, each loan payment you make decreases the interest you'll need to pay, since it decreases the amount of principal you have left to pay. So what that means is if you had borrowed for a $200,000 house, what's going to happen there is you may have a mortgage, and I'll be talking about mortgages a little bit later on. You may have to make $1,500 payments. But the thing on that, initially, about 500 of it may be principal, whereas $1,000 of it would actually be interest. Now, sometimes it's not quite that bad, depending on your interest rate and everything like that, but it can actually be that bad. But as time progresses, so that may be your first payment, by the time that you get to the end of, say, 10, 15 years, which would be, if you're making monthly payments, it might be at your 181st, that $1,500 mortgage payment, well, then it's going to be $1,000 on your principal and $500 on your interest, because you won't be owing as much. So overall, what happens is just every single time you make another payment, you're going to have less interest. You'll have less interest to actually pay. The reason that these amounts are usually so high, especially the amount of interest that you're going to be paying down, is because of the sizes of loans. Obviously, if it's a smaller loan, say only 200 or things like that, this amount would be much smaller. A $200 loan, depending on the interest rate, you may be paying, depends on what your payments are, you may be paying, say you're paying $25 payments, you may be making $20 principal payments, which means that $5 of it would be interest. But as you keep on paying it, by the time that you get to your 10th payment, that $25, it may be $24 of principal and $1 of interest that's actually getting paid. That kind of key aspect does play into effect quite well with paying down mortgages, because as you get very close to the end, you may have different agreements with your bank or creditor or anything like that. Any way that you're getting your mortgage, loan officer, that you may be able to make increased payments and be mortgage free earlier. So again, each loan payment you make means less interest that you're going to pay, and also decrease the amount of principal that you would have to have left to pay. So at $200,000, by the end of that 15 years, right? 15, yeah. You may only owe $50,000 of it. Now, there's three ways that you can always decrease the interest on a loan. First off, you can, if you are able to decrease the interest rate, the compounding frequency, or the term. So obviously, if you owe less interest rate, you're going to owe less money. Just like we had calculated that the more compounding frequency in section 1. Annual compounding frequency gave you, if you invested that money, gave you less money. But the more frequently, so we had the chart of 1 versus annual versus daily, you got more money if you were able to find something that compounded daily. So the opposite would be completely true as well. You can decrease your interest by decreasing your compounding frequency. At the same time, you can decrease your interest by decreasing how long you're going to have to pay for it. So how long you have to pay for it. You can also decrease the interest by increasing your regular payment amount or your payment frequency. So the more that you're paying means that you're going to have to pay less. If I go back here, instead of a $1,500 mortgage, if you were able to afford even $1,550, it's going to decrease the total amount of interest, because that means that you're going to have an extra $50 that's going to be paying off your principal, as opposed to owing $1,000. Well, it's going to be paying off more, which means that this interest amount is actually going to go down quite a bit more by the time that you get to that 15-year mark, and actually every single payment. At the same time, if you increase the payment frequency, if you pay something daily, and something's even compounded annually or daily or anything like that, if you increase the amount for that you're going to be paying on a, like daily versus weekly versus monthly, you're going to decrease the amount of money that you're going to have to pay. And one real key thing is you can always decrease your interest on a loan by making regular payments. If you wait until the end of a year to pay off something, you're going to be paying more money than you would if you were to pay on every single month. Because if you pay every single month and you have 12 payments, you're going to owe less than if you waited the entire year, and you would have so much more interest to pay. So a few things that you have to take into consideration are collateral and the Bank of Canada prime rate. So the collateral is some sort of asset used as security in case you cannot repay a loan. Some collaterals may be your house, some very expensive jewelry or vehicles. Collateral is just the idea of, well, I'm going to say that you can have my car if I don't pay you back. Now, bank is also going to consider depreciation of vehicles like that. Some vehicles depreciate. We'll talk about that a little bit later on, but it's some kind of asset, and we'll talk about what an asset is. The Bank of Canada prime rate is a value set by Canada's central bank, which other financial institutions use as a guideline to set their interest rate for loans. Meaning, there is a set rate that all of Canada usually follows, and every single bank within Canada usually tries to use it as a guideline to set their own rates. Now, some banks may have higher interest rates depending on different things. Some banks may have lower. And it will depend on what kind of products they're offering, what kinds of community they are in, basically what kind of financial backing they're going to have. There's lots more stipulations on what that means as well. So there's a few different types of loans. First up is a credit card. A credit card is essentially a type of loan. Credit cards offer incentives to entice you into them. For example, immediate cash rebate, low interest rates, no annual fees, rewards, any kind of thing to say, yes, you use our credit card, we're going to give you something. You'll have a minimum amount you have to pay each month, which is usually a percentage of the outstanding balance. Most ones that I see are about 5% of the balance. If you don't pay that 5%, then they're not going to let you keep on using it without some kind of penalty. Now, credit limit is something that they offer. It's a maximum borrowing amount, and it's usually based on your credit score. Some credit cards don't even look at what your credit score is. They will just give you a credit card and say, yep, you can use it. You don't pay us back, well, we're going to charge you a whole bunch of interest. There's always benefits and drawbacks to a credit card. I'll talk about one thing at the end of this. A credit card with only one purchase on it can be treated as a loan with usually a high interest rate. So if you only buy one thing on it, you essentially can treat it as a loan because you don't actually have that money. It's the credit card company that has the money. You are borrowing money from the credit card company to pay something, and you have to pay the credit card company back. Credit cards also offer cash advances. That means that you can get cash out instead of purchasing something. It's like what you do with a debit card. Now, the biggest thing about cash advances, though, is you get charged interest from the day you take the money out. And it often does have a greater interest rate. Which means if you want to take $20 out because you want to pay your mom back, well, you're going to be getting interest charged to you just for trying to pay your mom cash. Now, in the world of electronics and being able to do e-transfers and everything like that, cash advances may have become a lot less common, but there are still many people who do that, and there are cash advance companies that deal with that. But we'll talk about that as well a little bit. What I wanted to talk about credit cards is this idea of the credit score. Now, you do have to have a good credit, and the only way that you can really build a credit score is by having a credit card. If you don't have a credit card, it means that essentially banks can't loan you any money. They don't know your reliability. If they can't trust you to pay something back by showing them that, yeah, you have a good credit score, they're not going to offer you a mortgage. Or this is usually one thing that many students get into as well, is they can't apply for their own student loans because they don't have a credit score. My word of advice is absolutely to apply for a credit card, but pay it off immediately. Buy something and pay it off. Credit cards are great. I love the incentives that my credit card has, but I sure make sure that I make every single payment on time. I set reminders. I make sure that I pay it off, because all of that interest can really hurt you. And there's a whole bunch more stipulations on those credit cards. Line of credit. Now, a line of credit can be very, very much like a loan, but it's slightly different. It's a pre-approved loan offering immediate access to funds with a minimum monthly payment, meaning you do have to make monthly payments every single time. Whereas say a student loan, you may not have to pay back until you're done your schooling. But usually there is still a minimum payment with those student loans. Now, a line of credit usually offers a lower interest rate than most loans and credit cards. So you're good for helping pay off other more interest accumulating debts. Some banks will also offer consolidation credits or consolidation loans, which basically combines any and all of your loans together so that you only have one thing to pay. It can be good, it can be bad. If I talk about student loans again, well, they have usually a minimum loan payment, and typically, because banks are very accommodating and very understanding, they even have a lower interest rate than a line of credit. Not always, but sometimes you can, depends on who you talk to. Secure line of credit offers you a lower interest rate if you offer up some collateral. So if you offer up some kind of asset, you can get a very secure line of credit. So some other types of loans are mortgages. So a mortgage is a loan for purchasing real estate, houses, property. The real estate is then your collateral. which means if you don't pay off your mortgage every month or every 2 weeks, however you have it set up, the bank or loaner can repossess your house or your property. I said that we talked about payday loan, which is very much like having this cash advance. Not exactly, because a payday loan has an even higher interest rate. It's usually for a very short term if you need money before you get paid. For example, if you have to get your car fixed immediately because you can't do anything else, you may have to get a payday loan. There's lots of different companies and lots of different places in larger centers that offer payday loans, but they offer a very high interest rate and they expect that your next paycheck pays them back, or else that higher interest rate is going to hurt you. It's going to ding you back. There's also dealership or in-store financing, which you often have conditions on how the loan is to be paid back, which can result in unexpected costs or penalties. Always read the fine print. That's always going to be your word of caution. Read the fine print. A little more reading. Buying, renting, or leasing. So a lease is a contract for purchasing property that you use, for example, building, vehicle, from a lessor, leaser, for a specified period. I have to put that little reminder in myself. So basically, it means that you can purchase it after a specified period. That means that you can still use it for that time. So for cars, you can get free repairs, service for as long as you don't go over specified mileage. For houses, you have to stay in the house for a specified amount of time. Usually you can have a year lease or a 2-year lease. But after that time, you can usually there's some options to either buy the property or buy the car or completely move on. No strings attached. You don't have to find someone to buy your car. Don't have to find someone to buy your house. You can just move on and go. So rent is even less commitment than a lease because you just pay as you go for what you use. If you rent a vehicle, well, that's all it is. If you rent your house, you just pay month to month or year to year or anything like that. A few more definitions. Equity is the portion that you actually own on an item. So the value of the item or minus the amount still owing on it. For example, a car, you may purchase, the purchasing price may be $20,000. If you're leasing a car for 3 years and you've already paid, this is a severely low number, but if you've already paid, well, you would have probably paid more than $7,500 because they have to take money off. But if you would have technically owned, and I'm putting quotations on that, they could say, oh yeah, you have $7,500 of equity in this vehicle. Well, you can purchase it for the remaining $12,500 and then it's yours. That's kind of the general idea behind it, not specific. An asset. So we talked about assets. Well, what is an asset? It's an atom or portion of an item owned. Real estate, investment portfolios, vehicles, art, gems, etc. So anything that is of value that you own or own partially. Appreciation is an increase in an asset's value over time. Art, collector's items, there are many things that appreciate over time. Whereas there are also things that depreciate also or decrease in value over time. So wear and tear in vehicles, houses. You may think that the shirt that you just bought is so spiffy, but it's not going to increase in value. You may have bought it for $50 2 months ago. Well, it will have decreased in value, usually at a quite good rate. You may only be able to really buy it or sell it for $10, $20. Disposable income is the amount of income after all regular expenses, like bills, loan payments, and taxes that must be paid. but they have been accounted for. So after all of your expenses, so your water bill, your electricity bill, your natural gas bill, your credit card, your loan payment, your vehicle, your mortgage, your taxes, after all of that has been paid, that is what your disposable income is. You have lots of responsibilities, and you have to make sure that you account for every single one of them. You can't say, oh, I forgot to pay my water bill, and say, oh yeah, I'm going to go to the movies 15 times this month. Well, that's not being responsible. You have to be responsible. A few other things. Upfront payments is a payment you would have to make on the principal of the loan right off the bat. A down payment, lease deposit, damage deposit. Now, if it's a deposit, it's usually refunded later. Now, it's a little bit different than what a down payment is. A down payment is paid up front, but it doesn't accumulate interest. So that's a little bit of a typo. That should just be one apostrophe. The remainder of the loan does. And last kind of definition before we get into examples is a cost-benefit analysis. It helps you to decide whether to buy, rent, or lease. So your costs, initial costs, fees, short-term, long costs, shorter long-term costs, disposable income, financing cost, depreciation, breaking contract penalties, equity, those are all your costs. So those are all the things that you need to take into account before you buy things. At the same time, you have to consider your benefits. How convenient is it? What are your commitments to it? What's the flexibility on it? Are there any personal needs or wants that are to whether you want to buy, rent, or lease? So let's get into some examples. And fancy enough, the three formulas that we've already been working with come again here. All the formulas that we used for investments are also used for loans, except instead of saving a lump sum and making interest, so having money to spend, you're borrowing a lump sum and paying interest. But we have two new formulas. There's a present value formula. Now, the P's and R's and all lowercase r, uppercase RT all stand for the same thing. For example, P still stands for principal, the current amount of an item. A stands for the future value. R is your rate as a decimal, N is your compounding periods, and the small t is your time in years. The capital R is a regular payment, a regular investment. The first formula asks basically, how much can you borrow? Because what the formula does is it calculates what the present value of something if you're able to make regular payments. So if you can only afford $50 a month, you can plug in your interest rate, your compounding period, and how long you're going to be borrowing something for to calculate what will be the maximum cost. This one is used a lot for mortgages. Say that you can only afford $500 a month. Well, you have to just put your 500 in there. Actually, we'll have an example, but then you can calculate your interest, your compounding periods, and how long your mortgage is going to be for, and it'll calculate exactly how much you can afford. Now, just a word of caution, if you're looking at mortgages, you have to also consider a lot of upfront fees, for example, lawyer fees, title transfers, whether you're going to be making a, I keep on forgetting whether it's a 10% or it's a 20% down payment. If you're able to make a 20% down payment, you don't have to have extra fees to do some research into that. But if you only make it 5%, then you're going to have extra interests on it. Regular payment formula is almost the same kind of thing as this one. It's just if you know how much something is right now, it tells you what the regular payments would be, which is different than this formula where it tells you what your regular payments would be to calculate what the future value of something would be. So this one's using a principal to calculate the regular, what your regular payment is. So just like I described before, present value, I'm just going to add in that A, well, I guess in our new formulas, but new formulas don't have an A, but it is in our previous three. A is still your future value. So let's do some examples. First example, you want to buy a home with a 30-year mortgage at an 8% annual rate, compounded monthly. Now, if you can only afford $800 per month, we're going to calculate the maximum cost of a home that you can afford. Now, that's assuming that you don't have any kind of upfront fees, lawyer fees, transfer, all of that kind of stuff. We'll just say if you can afford $800 a month, how much can you afford? What is the maximum house cost that you can actually buy? That means that we're going to be using this formula. So the principal would equal, so the present value would equal whatever our regular payments are, bracket 1 subtracting in brackets 1 add r over n to the power of negative exponent nt divided by r over n. So I just wanted to record that formula so that I can plug everything in. So because we're trying to calculate what our principal is, so what the present value is, we should know everything else. We know what the regular payments would be. You can make an $800 payment. 1 plus our rate is 8% annual, compounded monthly, to the power of negative 12 times 30. Now my recommendation, just as always, is calculate exactly what that exponent would be. Now in this case, it's a negative 360. All over 0.08 over 12, which means when I plug all of that into my calculator, if I can only afford $800 a month and I make a $30 payment, it comes out to $109,026.80. So if you can only afford $800 a month and your interest rate is 8% for 30-year mortgage, you can only afford a $100,000 house. Now, just as a quick side exercise, if you're making $800 payments every single month for 30 years, you will have paid $288,000. Huge increase to what your current house value is. If you want to decrease the amount of money you pay, decrease the interest rate, decrease compounding periods, decreasing the term, increase your regular monthly payment, increase how often you're paying. So instead of monthly, twice a month, even $400 every. Actually, I'll go to the page, but also by making regular payments helps. If you pay $400 every single month, you are not making 24 payments a year. It's very uncommon for people to be paying twice a month. Sorry, actually, oh, that's true. You can have twice a month. Usually that works out to be, in some cases, the 15th and the 30th. except for February, it'll be the 28th. But you make that $400 payment, you will have paid $9,600. But you can change this and decrease this amount by simply changing it to every 2 weeks. There are 52 weeks in a year, which means if you change it to every 2 weeks, you will have made 26 payments instead, which means you will have paid $10,400. And this amount, if we're paying $800 a month, well, this is not changing any of the amount, but it will decrease this total amount. You will have paid no more every single month, every single year. But the total at the end of those 30 years will decrease. At the same time, if you're able to afford every 2 weeks, that, how does it work? Yeah, that extra $800 a year will also decrease this even more than this one. All of these tricks are why financial education is extremely important. Many people take it in workplace 10, start having that understanding, especially with EI and your pay statements and everything like that. Taking it further into Foundations 30 is really great as well. Alrighty, let's do a second example. So Trina's employer loaned her $10,000 at a fixed interest rate of 6% compounded annually to pay for college tuition and textbooks. That means her employer is awesome. Basically paid for her schooling. Now, the loan is to be repaid in a single payment on maturity date, which is at the end of 5 years. How much will Trina need to pay her employer on the maturity date? What is the accumulated interest on the loan? So because she's paying in a single payment, we're going to come back to this formula, because this calculates if you're going to be paying a single future value, and if she is bored with $10,000, she is not making regular payments. At the same time, it says compounding, which means that we're going to be using the compounding interest formula. So I'm just going to write down the formula, and then I can plug in what I need. So the future value, she borrows $10,000 at a 6% interest, compounded annually for 5 years. Again, always evaluate that exponent. It comes out $13,382.26. That is how much she's going to have to pay her employer at the end of those 5 years. Now, if it's her employer, it means that she's also going to be earning money, which means there may be extra incentives for her to stay. Well, if her employer is paying for all her schooling, hopefully she does stay. There's usually a clause in those types of contracts that say if you don't work for your employer at the end of your schooling, it may be increased interest rates, it may be extra fees, anything like that. So making sure you're aware of that kind of information is going to be a very good thing to know. What's the accumulated interest? Well, if she pays $13,382.26, but her employer loaned her $10,000, the amount of interest that she will have paid is $3,382.26, which may be the difference between her going to school and not going to school. If she's able to have that $10,000, and that's actually not bad, that's essentially $2,000 a year for school, which is very cheap. Paying that much interest, not too bad. Third example. Suppose you take out a loan for a car that costs $21,000. If the down payment of 10% is made, you need to take out a loan for the remaining amount of money. Now you need to pay off the loan off monthly over the period of 5 years with an annual interest rate of a loan being 8.4% compounded monthly. What monthly payment is required to pay off the loan? How much interest will you have paid? So there's a lot of things in here, but the biggest thing is we need to find out what is the monthly payment on this loan. To find out what the monthly payment is, we're going to have to use this formula. The reason we are not using this formula is because we don't know what the future value is. We know what the present value is. The present value of our car is $21,000. So our formula, actually before I get to that one, I'm just going to have to do some extra calculations, but I will write down the formula. It is the principal, Rn, so Rn to the power of Nt divided by all of this. That minus 1 is a large one being subtracted from this final value. It is not being subtracted from the exponent. So in this question, they are making a down payment of 10%, which means that 21,000, we're going to find out what 10% of it is, in this case, $2,100, and subtract it off. That comes out as $18,900, which means you don't have to pay $21,000 or pay off $21,000 right away. You're only paying off $18,900. So let's find out what monthly payment you would need to pay off that $18,900. So our principal is $18,900. The rate is 8.4%, so 0.084 compounded monthly. To the power of 12, period 5, which means 12 times 5 is 60. All divided by, in brackets. As you type all this in your calculator, just make sure you have enough brackets. I set enough right in here, as long as you evaluate that exponent, to be able to do it in your calculator. If you have to do it one step at a time as well, that's perfectly fine. Now we already know that 12 by 5 is 60. So as we type all that into our calculator, we should receive a calculation of $386.85. That allows us to find out what the monthly payment is. So you would have to pay $386.85 every single month for this car. How much interest will you have paid? So the total amount of interest means taking that $386.85, if you're making that as a monthly payment for 5 years. So 386.85 times 12 times 5, you will have paid $23,211. Subtract off the original cost of the car minus that down payment. There be $4,211 $311 of interest. So as a loan, you will have paid $23,211. But that's not the total amount that you would have paid. You also would have paid this down payment of $2,100. So just a quick calculation, 23 to 11, adding that 2,100, or that $21,000 car, you would have paid $25,311. $4,311 of it would be interest. Alrighty. Here's a beautiful question that talks about appreciation and depreciation. So this is the idea. Let's see, is it on the front page or is it back page? Back page. It is talking about the increase of an asset's value over time versus the decrease of an asset's value. So there are many things that increase in value and there's many things that depreciate in value. Vehicles are one thing that depreciates. I think the general rule of thumb is as soon as you buy a vehicle, it depreciates by 30% as soon as you drive it off the lot. Yeah, it's an extreme amount. So that $100,000 car or a truck that you just bought, if you want to sell it the next day, you can only sell it for $70,000. Or your whatever company you bought it from would only buy it for about $70,000. So a luxury vehicle rental company depreciates the value of its vehicles each year over 5 years. At the end of the 5th year, the company writes off a vehicle for its scrap value. The company uses a depreciation rate of 40% per year. So meaning at the end of every single year, it will depreciate by 40%. So I'll show you the long way of doing this first. So the scrap value of a car is what we're going to find out. So car A is a 2-year-old vehicle and has a value of $43,200. So depreciation means we'd have to take that $43,200 and multiply it by 40%. We multiply it by that 40%. Comes out at $17,280. So it will have lost. Depreciation means it will have lost $17,280 at the end of that next year. So that $43,200 now loses $17,280 of value. So $43,200, subtracting that $17,280. $25,920. So that's a 2-year-old vehicle. That's a 3-year-old vehicle. So that after that next year, that $43,000 car is now just under $26,000. We do the exact same thing again. $25,920. Sorry, with the new value. We find 40% of it. It's $10,368. And we're going to have to take that off of the new value. So 25,920, subtracting that 10,368 is $15,552. Huge decrease. So that's a 4-year-old vehicle. And we can do it again, just with the new value. So multiply by the 40%. it's going to lose $6,220.80. 552 minus 6220, 72. The final value at the end of 5 years, sorry, at the end of the 5th year, it says it's scrap value. I should have made sure I mentioned that a little more specifically. But they claim that they're only going to be able to sell it for $9,331.20. This is the long way of doing it. Finding the percentage and subtracting it off. There is a faster way of doing it. And it comes straight from here. Because you're finding 40% of something and subtracting it off, it means this value is actually 60% of this. Which means another way we could have quickly done it is find out what is 60% of this value and that gives us exactly what it would be. We can apply that same understanding in this question. But we're going to take it a step further and have even less work. Multiplying by 0.6, this 1-year-old vehicle, so that's 60%, will give us what it would be worth at the end of the 2nd year. But if we multiply that value by 0.6 again, that will give us for the value after the 3rd year. Multiplying that again by 60% will give us for 4 years. And 60% again would be the 5th year, which means by our exponent laws, multiplying by 0.6 to the power of 4 will give us what its scrap value is in 1 line of work. That's a $75,600 car. At the end of 5 years, just going to put it in red, would only be worth $9,797.76. You can show all the work by the long method, absolutely. This is just a short way of doing it. Same time, we can find out what the original purchase prices of these cars would be. And we can do it in the exact same kind of understanding as what we just did it here. So if we talk about car A, well, we found out that if we took $43,200 and multiplied by 0.6, it would give us what its value would be at the end of the next year. So if we know that some value, sorry, I'll change my variable. Some value multiplied by 0.6 to the power of 2, because it's a 2-year-old vehicle, gives us $43,200. That value multiplied by that 60% 2 times gives us what its value would be at the end of 2 years. So to quickly solve for our original price, we just have to divide it by 0.6 to the power of 2. And that initial luxury vehicle would have been worth $120,000. For car B, it's the same kind of understanding. What number? Now the only difference is It's a 1-year-old vehicle, which means it only depreciated once. So only 0.6. What number multiplied by 0.6 gives us $45,600? There are multiple ways of doing it, but this is one very quick and fast way. To solve for our question mark, we divide it by that 60%, and that original vehicle was worth $126,000. And that still relatively works out because that vehicle, after its scrap value, is still worth more than the 2-year-old vehicle, which was worth less. Because the 2-year-old vehicle initially cost less. It had a smaller initial value. And there we go. So let's do some costs and benefits analysis of renting versus buying. Two couples made different decisions about whether to rent or buy. Helen and Tim bought a house for $249,900. They've negotiated a mortgage of 95% of the purchase price, so they'll need a 5% down payment. The mortgage is compounded monthly at 5.5%, has a 20-year term, and requires monthly payments. There should be an H in there. Don and Pat, though, are renting a house for $1,600 per month. They plan to renew the lease yearly. After 3 years, both couples decide to move. Helen and Tim discover the value of their home has depreciated by $10,000 or 10%, over the 3 years. Compare the amounts they would have spent on their homes. So the first thing, if you want to do Don and Pat are fastest. They pay $1,600 a month for 3 years. So after that 3 years, they will have paid $57,600. They will have paid that much money but they do not have any ownership of the house. They're renting. They have absolutely no ownership. A little bit different than a lease because they could have possibly bought the house after at a reduced rate. Say that they were the same value, same value of the house. For Helen and Tim, we're going to have to do a few things. For example, we're going to find out what is this 5% down payment. Oh, add an extra 9 in there. What is 5% of $249,900? They will have paid $12,495. After that, they have to take out a mortgage for the remaining 95% at 5.5% for a 20-year term. So we're going to find out what regular monthly payment are they having to purchase it for. Our formula will be this one. So I'm just going to fill in the information as is. Oh, forgot one thing. We don't have a $249,900 house or loan that we're paying. We're going to have to calculate how much is that actually going to be taken out for. If you make a down payment, you don't have to take a loan for that amount that you already paid. That's $237,405. So $237,405. Now we can fill in the rest of our information. 5.5% compounded monthly. monthly, a 20-year term. Evaluate what my exponent is. And 0.55 over 12. Again, 1220, which is 200. Oh, didn't change color. 240. Subtract the 1. And the regular payment, regular monthly payment that they would be using to buy this house. Oh, sorry, just changing my color. Comes out as $1,633.08. So at the end of 3 years, monthly for 3 years, 1633.08, they will have paid $58,790.88, which is a lot less than what Don and Pat has paid. At the same time, Helen and Tim have this additional $12,000 that they would have paid as that down payment. So that one works out. Oh, $12,495. They will have paid a total of $71,285.88. Their equity in their house is not going to be that specific value. It's going to be a bit less because of interest and everything like that. But one other thing that we do need to have as a calculation, just as to help us compare, is that Helen and Tim's house has depreciated by 10%. So that 240, let's change colors. I'll use orange. It's depreciated by 10%, meaning it's only going to be worth 90% of that original value. They're only going to be able to sell it for $224,910. If you round it, $225,000. So that's the current value. So let's look at a few different distinctions. Helen and Tim have paid $71,000 on their house. They own a portion of their house. It's not going to be, again, it's not going to be specifically 71,000. I'll do a rough estimate. They might only own $55,000 of their house. Again, that's to deal with interest and everything like that. Whereas Don and Pat have paid $57,600 in the house that they were renting, but they don't own any of that house. They decide to leave. They don't have any obligations to try and sell their house, but they will have already paid so much money. By renting means that usually if anything were to break or deteriorate, the owner of the house would have to make sure that it's fixed. So there's a whole bunch of different things that you need to take into account. If we're just comparing, Don and Pat probably have a sweeter deal. They will have paid almost $14,000 less, but when Helen and Tim go to sell, they're going to be selling for this amount, which means they'll be making a nice profit. Of course, that profit will be going into buying, hopefully, another house. So if we were to try and make a comparison, Both of them have their benefits. At the same time, Don and Pat don't have to worry about the real estate market. They don't have to worry about, oh, I have to get rid of my house, which is now only worth $125,000. They can just up and move. If they have $1,600 of spare cash every month, great. Maybe they want to move in with their kids after. But the comparison, both of them have their benefits. Of course, both of them have their drawbacks. Don and Pat don't owe their house. But they also don't have to sell. So that's a drawback. That's a benefit. Helen and Tim, they do own their house. They'll make a profit from their selling. At least that's my understanding of it. But they paid more, which is certainly a drawback. At the same time, the market might be bad. Might not be the greatest time to sell this house. Keep on going through a few of these types of rationales and types of thinking. John has a $475 car insurance that's due. He does not have enough cash to make the payment, so he's considering these two credit options. Which is a better option? He can borrow the money from a payday loan company for a $100 fee if it's paid back in full within 2 months. Or he can get cash advance on his credit card, which is carrying a zero balance. That's a real kind of key aspect to understand. Interest charge for cash advances is 19.99% compounded daily and takes effect immediately. He can afford to pay the required $5 minimum payment after their first month and then pays off the balance if full at the end of the second month. That does not sound grammatically correct. It should be read as in full. Now, the biggest thing is our formula does not actually work well when you're making different types of payments. For example, the formula doesn't work well when you have a different compounding period versus how often you're paying it. So that means we have to go to an online calculator. And the first thing on my online calculator that comes up is as I try and put in my information, it says I have to have at least a minimum payment of $7.91. Now those are pretty, I've checked a few of them, but overall, here's going to be your understanding of this type of question. I'll probably have to take this question out of future notes, just because it's dealing with different information and you do have to do some special calculations with it. Actually, yeah, because it's compounded. Well, no, let's do it. Let's do it. So first off, payday loan has $100 fee. $475. Add the $100. Comes out as $570. $575, which means that's how much you're going to have to pay. For the cash advance, we're going to do some special information. Now, the first thing is we are actually going to find out a future value after the first month. After the first month, sorry, that should be 475. We're going to find out what the full value is after the 1 month. So at the 19.99% compounded daily compounding. Now the biggest thing is we're going to have a time in years. Now after 1 month, that's only going to be 1/12 of a year, which means in our exponent, we're going to have to do an extra set of brackets. And as we type that into our calculator, it comes out as $482.98. If John pays $5, and that's why this amount is coming up, it's because it's very close to here. We take the $5 off, whereas if we took $791 off, it would be almost right back to $475. We'd be at $477.98. Same kind of information. We're just going to calculate it. What would it be for the second month? Same kind of information, just a higher value amount. 365 again for 1 month. And we get $486.01. So in total, John would have paid $491.01. Whereas using the payday loan, he would have paid $575. Obviously, financially, the credit card is a better option. But here's the thing that you don't consider. By agreeing to pay that higher amount, your credit score is not affected. Whereas using your credit card and not paying off the full balance, does affect your credit score. Now there are different kinds of things, but here is the kind of stipulation. As we had calculated just using the online calculator, it has said that you have to have a minimum payment of $7.91, whereas this one is saying that they're only needing $5. So there's a few things that I need to work with this question. By using this payday loan, your credit score is not affected. By actually making a minimum payment, your credit score apparently does not actually get affected. But by only making that $5 payment, which is, yes, only $2.91 less than it, because you're not making the entire minimum payment, or what the actual required minimum payment would be, it does not, or it would actually negatively affect your credit score. So I got to do a little bit of work on this question to make it a little more viable, but I'll do that later on. The bits that I need you to understand is, yes, credit cards are great, but you have to be responsible. All right, last example. This one I believe is pretty quick. is relatively. Amanda is a civil engineer. She needs a vehicle for work on average 12 days each month. She's been renting a vehicle that she needs for $49.99 per day. She could lease a vehicle, which requires a down payment of $4,000 and lease payments of $380 per month plus tax. She would need insurance, which can be paid monthly, and would have to pay for repairs and some maintenance on average of $50 each month. She would have no equity in the vehicle. She would not own any part of it at the end of the 4-year lease. She could buy a vehicle for $32,000 and finance it for a 4-year term at 4.5% interest compounded monthly, and would have the same insurance and repair costs as leasing. Which option would you recommend for Amanda? So the biggest thing is, let's look for the fact that this is a 4-year thing. So let's see what our options are. If she's going to rent for $49.99 for 12 days in a month, there's 12 months in a year for 4 years, she will have paid $28,794.24. At the end of those 4 years, she'll have paid almost $29,000. Her options for leasing is a down payment of $4,000 plus $380 per month plus tax. Now in Saskatchewan, that's 10%, which means we can actually multiply by 1.1. Sorry, actually, we're at 11% right now. Shoot, forgot about that. That's going to be every single month. For the 4 years. She'll also need insurance, which averages of $50 each month. So $50 for 12 months for 4 years. So I'm going to do those calculations a little bit separately. 380 multiplied by that 1.11 multiplied by the 12 multiplied by the 4 comes out as $20,246.40. And the insurance total cost comes out as $2,400. So $2,400, add our $4,000, add the $22,46.40 to lease, comes out as $26,646.40. Now the lease obviously comes with some other stipulations. For example, she can't go over a certain kind of mileage, all of that kind of stuff. Renting, she may not get the same vehicle every single time. But our buying options, we're going to find out what is her regular payment going to have to be. So our regular payment with our $32,000, 4.5 compounded monthly, fill in all of our other information. She's financing it for the 4-year term, which means that's 48 as our exponent. Therefore, 5 over 12. Sorry, usually I'm using square brackets for those locations, sorry. So the buying option comes out $729.71. So let's finish off our calculations. $729.71 payment every single month for 12 months, 4 years. Adding same insurance and repair costs, so the $2,400. This one comes out as 35, sorry. So total cost, $37,426.08. So let's look at what is going to be the best thing for her. Well, if she buys it, she owns it, which means at the end of those 4 years, if she wants to upgrade or do anything else, she can sell her vehicle. Now, depends on what type of vehicle, how well she maintains and everything like that. She might be able to recuperate some of her cost. Leasing, yeah. Leasing looks like she's negotiating a contract that she actually has to pay for her own repairs. So that's not going to talk about repairs. But in this case, she could buy it out after the 4 years. Renting is here. Now, it depends on which would be the best. She may want to just rent because there may be some months that she doesn't work, which means that this cost may go down. Leasing, obviously, is going to be the cheapest. But what she wants to do, it's going to affect what her option is going to be. You can make an argument for all three. Sorry, for any of the three. That's all I'm going to ask you to do. And obviously, justify your answer. Now you can have some fun.